Here's the truth. Profits don't come from tips or flashy indicators. They come from discipline. In Trading for a Living, Dr. Alexander Elder proves that you don't trade the market, you trade your own behavior. Your edge is built on 3 pillars: mind, method, money. Master your emotions, stack time frames with the triple screen, and cap your risk so small that a losing streak can't break you. Starting now, you will stop guessing, stop chasing, and begin executing rules. If any part of your process is built on hope, you will pay for it. Today, you install a system: clear entries, planned exits, fixed risk, and a journal that exposes your mistakes. Stay to the end. There is one quiet rule that kills account bleed, and most traders never use it. You are not here for inspiration. You are here for control. If you are new, inconsistent, or stuck at break-even, this breakdown gives you a simple plan you can run this week. Elder's playbook is not a theory. It is a set of rules you can test in real trades. One higher time frame to define trend, one working time frame to find pullbacks, and one lower time frame to time entries. You will cap risk per trade, predefine exits, and track behavior in a journal so your results stop depending on your mood. If you want more book-backed, zero-fluff playbooks like this, subscribe now and turn on notifications. This channel is a training ground. You will get the rules, you will apply them, and your process will get sharper starting today.
Move 1. Mind over market. Control yourself first. You spot a clean pullback. You enter early, move the stop, add size, then watch the candle rip against you. The setup was fine. Your behavior wasn't. That is the pattern. Good ideas, bad execution. Death by impulse. Cold truth? Indicators are harmless until your emotions turn them into weapons. If you cannot follow rules under pressure, no method will save you. Rule: head before signal. Here is your tool, the Pre-Trade 60. For 60 seconds, you stop touching the mouse and run 3 questions out loud. What is the bigger picture? Trend, key level, and session context. What kills this trade? The exact price that proves me wrong. What is the risk and size? Risk in currency, position size, and stop distance. If you cannot answer all 3 in one breath, you do not have a trade. Now set your action line. Write this sentence at the top of your journal and repeat it before every entry. I will enter only if the higher time frame agrees, my stop is placed, and the risk is under X%. Fill in the percent. 1 or 2. No exceptions. Add a behavior guard. 2 trades per session maximum until you log 10 straight rule-based entries. Revenge trading dies when your capacity is capped. You have the mind anchor. Next, you need the market filter. Stack your time frames and let the triple screen do the heavy lifting.
Move 2. Triple screen. Stack your time frames. Most traders stare at one chart and pray. Professionals stack time frames and filter noise. The triple screen does 3 things for you. It defines the wind, it finds the wave, and it times the surf. Screen 1. Higher time frame sets bias. Weekly for swing traders, hourly for intraday. Ask 2 questions. Is the trend up or down? Are we near a key level that can reject the price? If the higher time frame is up, you are a buyer on dips. If it is down, you are a seller at rallies. No mixed signals, no counter-trend heroics. Screen 2. Working time frame hunts the pullback. You wait for the price to move against the prevailing trend and show signs of fatigue. Use a simple tool, a moving average slope, a channel touch, or a momentum oscillator leaving an extreme. Your job is not to predict. Your job is to detect the moment when a pullback stops breathing. Screen 3. Lower time frame triggers the entry. You want a clear pattern that hands you a defined stop, a break and retest, a small double bottom in an uptrend, a lower high in a downtrend. Place the stop where the pattern is invalidated. Do not move it. Here is your action plan. Pick your 3 frames now. For swing, weekly, daily, 4 hours. For day trading, hourly, 15-minute, 3 to 5-minute. Write your yes or no rules for each screen. Bias must be yes, pullback must be yes, trigger must be yes. If any screen is no, you stand down. Waiting is a position. You have alignment. Next, you need precision. Entries are cheap. Exits decide your paycheck.
Move 3. Entries and exits without guessing. Here is the rule. Entries are cheap. Exits are everything. Entry. Trade only when the higher time frame bias is clear. The working time frame shows a pullback, and the lower time frame shows a pattern with a defined stop. If you cannot define the invalidation price in one sentence, you are gambling. Enter near structure so your stop is tight and logical. Do not chase breakouts. Let price come to you or pass. Stop. Place it where your idea is wrong, not where it feels safe. If the pattern breaks, you are out. No moving stops wider, no averaging into losers. Your first loss is your smallest loss. Exit 1. Target-based. Scale at a 1R to 2R objective and take a partial ride if the higher time frame trend is strong. Exit 2. Trailing. Trail behind swing lows in an uptrend or swing highs in a downtrend. Pick one method and stick to it for 20 trades before judging. Action. Write one sentence for your primary setup. I buy the pullback to the 20 EMA in an uptrend when the 5-minute prints a higher low. Stop under the swing. First target at 2R. Trail the rest behind higher lows. Put that sentence in your journal. Trade that plan, nothing else. You have rules for entry and exit. Now protect your account. Money management decides who survives long enough to learn.
Move 4. Money management that survives. Cold truth. You do not blow up from bad entries. You blow up from bad sizing. Rule. Protect capital first. Profit comes later. Set a hard risk per trade. 1% for beginners, 2% only when your rules are airtight. That is the maximum you are allowed to lose when proven wrong. Size from your stop, not your feelings. Formula. Position size equals account risk in currency divided by stop distance in currency. Example, account 10,000. Risk 1% is 100. If your stop is a 50 cents per share, buy 200 shares. If your stop is $2 per share, buy 50 shares. The stop decides the size, not the other way around. Place the stop where the idea is invalidated. If that level is too wide, the trade is too expensive for your account. Skip it. There is always another setup. Ban averaging down. Your first loss is your cheapest loss. If you add only to winners after price moves in your favor and risk is locked. Install 2 breaks, a daily loss limit at 2 to 3 times your per trade risk, and a max trade count per session. Hit either and you stop. Decision quality falls fast after pain. Your job is to live to trade tomorrow. Weekly circuit breaker. If you draw down 5 to 7% in a week, stand down and review. Your system needs calibration, not more attempts. Action. Write these numbers on paper now. Risk per trade, max daily loss, max trades, circuit breaker. Tape the paper to your monitor. These are walls, not suggestions.
Move 5. Journal and feedback loops. You cannot fix what you do not see. Most traders track P&L and miss the behavior that created it. Professionals journal to expose patterns, remove mistakes, and reinforce rules. What to record for every trade. Date and ticker, the 3 time frames you used. Higher time frame bias and why. Trigger pattern on the working and lower time frames. Entry, stop, target. Risk in currency and R multiple. Emotions before, during, and after. Outcome in R. One lesson in one sentence. What to measure each week. Rule adherence rate. Percentage of trades that met all written criteria. Average R per trade. Win rate is interesting, but R tells the truth. Maximum drawdown. Time of day and day of week performance. Setup tags with edge. One recurring mistake to remove next week. Rule: if it is not written, it did not happen. Data makes you honest when memory won't. Action: commit to 10 trades with full journal entries. Do not change your system during these 10. On day 7, print your screenshots and notes. Circle 3 things: your best setup, your worst habit, and 1 rule to upgrade. Keep only 1 change for the next 10 trades. Improvement comes from small, deliberate iterations, not constant system hopping.
Move 6. The trader's weekly routine. Routines make profits boring. That is the goal. Before the week, scan higher time frames, mark trend, key levels, and major sessions. Pick 2 A setups you will allow. Everything else is a distraction. Before the session, 3 minutes. Confirm higher time frame bias. Place alerts at levels so you do not chase. Read your risk numbers out loud. 1% per trade. Max daily loss. Max trades. During the session, trade your plan, not your mood. If bias flips on the higher time frame, stand down until the working time frame aligns again. Take a 2-minute break after each trade to reset. If you feel tilted, close the platform. Your edge is decision quality, not screen time. After the session, journal entries, exits, emotions, and 1 lesson. Tag every trade by setup. Screenshot and annotate the chart. 5 minutes, then stop. Do not redesign your system at night. Weekly review. Sunday. Count rule-based trades. Compute average R. Identify 1 mistake to remove and 1 strength to double down on. Adjust only 1 rule for the next week. Rule: routine beats mood. If you run the routine, your equity curve calms down. If you wing it, your results will too.
Set 2 breaks and obey them. 1, a hard daily loss limit. 2, a hard trade count limit. When either hits, you stop. No debate. This cuts emotional variance, protects capital, and preserves decision quality for tomorrow. Most traders spiral after pain because there is no end line. You will have one. Your daily loss limit sits at 2 to 3 times your per-trade risk. Your trade cap fits your plan, not your ego. Limits save accounts. Ego empties them. Memorize it and post it where you trade. You've installed the bricks. Now you need the roadmap, so the next 7 days run on rails. Here's the plan. Define 3 time frames and write yes or no rules for each triple screen. Set risk at 1 to 2% per trade. Fix your daily loss limit and cap your trades. Journal every entry with stop, target, bias, emotion, R result, and 1 lesson. On day 7, review and keep only 1 adjustment. Expect boredom. That is a win. Process beats prediction. Discipline turns average setups into income. And if you want to sharpen the lens you make decisions through, read Thinking, Fast and Slow by Daniel Kahneman. Elder gives you rules. Kahneman helps you see the biases that break them. You will notice overconfidence before it sizes you too big, feel loss aversion before you move a stop, and refine your pre-trade checklist to filter noise from signal. If this gave you one rule you will actually use, subscribe for more book-powered playbooks without fluff. Turn on notifications so you do not miss the next breakdown. Comment on the single rule you will install today. Say it in one sentence. Writing it down hardwires it. Your process starts now.